Hi, this is Scott Starratt with Starratt Wealth Management, part of Canaccord Genuity Wealth Management. Today, we're really fortunate to have on our call David Burbach. And David is the co-manager at the YTM Capital. YTM Capital is located in Oakville, Ontario, and was founded in 2010 by David's partner, Daniel Child. And the two of them have spent a lot of time in the investment industry. David, prior to YTM, was 17 years at Mackenzie Financial, most recently as their general counsel. So he has a lot of experience when it applies to the law, as well as how to manage money in this very unique stage. David, thank you very much for coming aboard and agreeing to do this.
Good morning, Scott. Thank you for the opportunity. Appreciate it.
Yeah. So let's get right into it. And just from a personal side, how did you decide to manage money, and how did YTM come together?
As you mentioned before, it started in 2010. Daniel was the head corporate trader at the Bank of Nova Scotia for many years. He had learned all he could in that business and was looking for something new to do. So he set off on his own and started investing his own money in mortgages and developing real estate as well. In the process of doing that, he thought, I think there's a business here because there's a very good investment opportunity. And that was the genesis of YTM, the firm. Daniel talked to me in 2013 and convinced me that it was a good opportunity for me as well. We have very similar backgrounds in the sense that we've managed risk over long periods of time. His risk is a different kind, credit risk. Mine's legal and business risk. But we lined up in terms of values very closely along that axis. So I agreed to join, and he and I managed the mortgage income fund for YTM Capital. A third partner joined in 2015 named Carl Burnham. Carl was the head of credit trading at CIBC World Markets for many, many years. And he and Daniel managed two credit hedge funds for YTM. So we have three funds in total, mortgage income fund and then two credit hedge funds, and we manage about $500 billion in assets. In terms of who we are, I'd say Daniel's and Carl's half full perspective on the glass of water in front of them is a bond trading ethos. It's a way of looking at the world. And that drives a lot of the behavior decision making in the shop. We're wondering what can possibly go wrong next, where are the risks lurking, and with the ultimate goal of preserving investors' capital. Should mention that we all have a substantial portion of our personal portfolios invested in funds, so we're completely aligned with investors. Maybe more importantly, our parents are investors in the funds too, and we don't want to let them down. So that's the guts of what YTM is about.
Oh, great. Yeah, and I think the strategy in particular, if we concentrate on the YTM Mortgage Fund, the strategy is relatively unique. There's a lot of, real estate investments that are out there in Canada and in North America, and they've been tested the last little bit. But, the fund that you manage has held up very, very well. Why is that? Maybe describe how you would, tell your parents about what the mortgage fund is. What do you do for a living?
It's interesting. There are two things that make us unique compared to other mortgage funds. We have we're born and raised in the capital markets rather than the mortgage brokeraging industry. And that's important for the reason that we don't originate our own loans. We only buy them from other entities. And you might ask, why is that important? Well, if you originate the loan, you earn a fee for finding the loan in the first place. And then if you put it in a fund, you earn a fee for managing the fund. You might have a conflict on risky loans where you decide that you need that underwriting fee or that origination fee up front, and you may be inclined to put that loan into your fund where you wouldn't if you were just managing the fund. So we think that's a critical difference. We're regulated by the OSC. We think they're a good regulator, and that's the world we grew up in. So I think investors can look to a little extra layer of protection. That's actually a relevant layer of protection that they can benefit from. The second thing that's unique about our fund is we have a very strong relationship with a company called MCAP. MCAP is a large mortgage lender. That's their only business, effectively. They lend about $15 billion a year in mortgages to the Canadian public, and they administer about $65 billion a year. Why that's important is they're very good at what they do, and they have very strong processes for investing in mortgages or finding mortgages and then selling them to investors like us. That relationship means that investors in our fund can benefit from MCAP's expertise and also from ours. And by that I mean MCAP underwrites the mortgages initially that we buy from them, and then we underwrite them. And occasionally we will put mortgages back to MCAP. So it's not a we'll take what you give you type of relationship. There's some real structure around underwriting and understanding the risks inherent in the mortgage. So what investors get out of that is an expertly underwritten mortgage portfolio. And the other unique thing that MCAP gives us is access to insured mortgages. Roughly half the portfolio right now is insured mortgages. These mortgages are insured by the CMHC, and what that means is we can't lose money in these mortgages provided that they were underwritten properly. MCAP has never lost an insurance claim request with CMHC. So with the backstop of the federal government, half of our fund is protected, where no other fund can say that in Canada. So it's a really unique investment opportunity from that perspective.
Well, that's great. And I mean, one of the things that people hear about when they hear about real estate or mortgages, and in particular buying the pool of mortgage, is what happened in the subprime back in 2007 and 2008.
Yeah.
So explain a little bit further. So MCAP, will underwrite the initial mortgage before it goes into the fund. But, how many mortgages would end up in the fund, and what do you specifically do when you get a mortgage across your desk? I mean, do you just get this big document that's dumped to you that says, I know you say you can port some back, but kind of what do you do internally in order to kind of make sure that the risk in the portfolio is reduced?
We have about 1,600 mortgages in the portfolio right now, so diversification helps, obviously. We have geographic diversification as well. We're in Ontario, Alberta, and BC mainly, a little bit in Manitoba and Saskatchewan, but not very much. So stronger economic provinces generally. So that diversification helps as well. In terms of the underwriting process that you asked about, we have access to MCAP's portal of all documents that they create in connection with underwriting the mortgage. So they'll underwrite mortgages for a period of time and then offer, say, 50 of them to us, and they provide us with 30 days to review all the mortgages and determine whether or not we want to put any back. When we review the mortgages, we go into the portal and look most importantly at the appraisal. We're property first lenders. The borrower's credit's very important, but bad things happen to good people. And we want to know that if those bad things do happen to the borrowers, we have the collateral that we can take and satisfy the obligation of the loan if the borrower can't live up to those obligations. So understanding the value of the property is very important from our perspective. We spend a lot of time in the appraisals. MCAP only uses approved appraisers. We give them feedback if we don't like appraisers and they don't use them anymore. So we spend a lot of time there. We spend a lot of time on the underwriter's notes. The underwriter at MCAP goes back and forth with brokers and borrowers, asking them questions and dealing with issues. And that information is very important to us in terms of deciding whether or not to take on a loan. Another way we try and protect investors who invest in our fund is when we invest in uninsured mortgages, they're typically, they are all 95+% primary residences. They're in urban centers, but they're not right in the middle of urban centers. They're in the periphery, Surrey in BC, Cochrane in Alberta, or Pickering in Ontario. They're starter homes or second homes. The average appraised value of our homes is about $450,000. I think that's important because there's more volume in those markets, which means if you have to exercise your legal rights over the collateral, it's easier to do so to sell into those markets. And we also believe that higher price point markets suffer more when housing markets go down or sideways than lower price point markets. So we think that there's some built-in protection by limiting ourselves to smaller mortgages on smaller properties.
Awesome. Now, one of the things that the fund has, gone into in the last few years has been the New York market. and it's now represented, a sizable amount of money within the fund. How did that come to be, and why is that different, say, from the Canadian CMHC slash primary residence type of market?
Yeah, we have about 21% of the fund invested in New York right now. About 6 years ago, we were referred to an institutional broker in New York who had a great track record, and got to know him. We spent 9 or 10 months in due diligence with this gentleman in New York, and became comfortable, A, that he knew the market, and B, that he had the same value set that we did. He's very conservative in his underwriting, and he brings a lot of value from that perspective. So the types of loans that we invest in New York are different. They're construction loans mainly. The borrowers are experienced, wealthy individuals who buy dilapidated buildings and renovate them. They're typically 8 or 10 or 15 unit buildings. They're renovated and turned into rental units. So from the period when the borrower buys the property to the time that they start renting it out to individuals, conventional banks won't lend against the collateral that's being created because there's construction happening. So we step in that space. Because the people who borrow the money do it many times, they're very good at execution. And the benefit that the broker brings is he knows those individuals very well. I should mention the broker often invests alongside us on these loans, so his goals are aligned with ours. So through that process, we have diversification in terms of markets and country, obviously, which we think is an added benefit to the fund. We hedge all of the Canadian dollar exchange risk away. In other words, if the dollar moves against us or for us, the fund's agnostic to that movement. It's just a Canadian dollar investment from our perspective. And I should say, in the time that we've invested there, we haven't suffered a loss yet. So it's been a very good experience, and we continue to hope it'll continue that way.
Right. Awesome. So as of right now, we're currently sitting at record low interest rates. Obviously the mortgages, I think, are very, very low right now. What you would get, in the States, if you lock it in for 30 years, or in Canada for 5 years, it's very, very low interest. How does that affect the portfolio and the outlook for the future?
It's interesting. Mr. Macklem said this week or last week, rates are staying where they are for the foreseeable future, which adds more of an implication for the fund that he's done that in a positive way. There are two main impacts on the fund in terms of low interest rates. The most acute impact is a bigger picture macro one, and that is low interest rates stimulate the economy. If the economy is stimulated and does well, then the borrowers on our mortgages are more likely to make their payments, and the fund will perform better. So that's definitely a positive. The other positive, obviously, is if interest rates are low, that'll help the housing market. If the housing market's stronger, that helps our collateral retain its value and protects the fund from future losses. So I think that's the real benefit from the fund's perspective. It's interesting, there are three main components we've talked about in the fund. One's insured, one's uninsured, and the other is New York. Those markets aren't tied to the Bank of Canada overnight rate in the same way that other mortgage products would be. And by that, I mean, if the rate goes very low, that doesn't necessarily mean that the rates in our markets will change to the same degree or the same direction. It's really a function of the demand and supply in those specific markets that'll drive where the rates are going. And because there's not a huge connection there, I don't expect that lower interest rates from Bank of Canada will necessarily mean lower yield to the fund.
Okay. Good. Now, you had mentioned there before 1,600 mortgages. That's a lot of mortgages. That's a lot of work to go through. Obviously, all the underwriting on them. But the law of averages is there's going to be one or two or maybe a few more of those people, for, like you said, good people, bad situation, for whatever reason, that have to sell or walk away from their house. How have you worked that out? One, has it happened? And two, how have you dealt with that? How have you collected on the security?
Absolutely, it's happened. Fortunately, not to a large degree, but it has happened. One of the benefits of our relationship with MCAP is they have a large workout department. There are 12 people in their department that help with defaulted or loans in arrears and then defaulted loans. So as soon as a borrower misses a payment, MCAP is on the phone with them the next day. And the majority of those situations get resolved relatively quickly. Where the borrower is in real trouble and it won't be able to satisfy the obligations that they've entered into in the mortgage agreement, MCAP starts enforcing its legal rights as soon as possible, and they're expert at it. They know the laws of each jurisdiction, and those laws vary depending on where you are. So they, with our guidance, in the sense that they're asking for our recommendations over time, will enforce our legal rights. Worst case scenario, often these things get worked out as they progress along in time. And it's always better from our perspective for someone to stay in their home and try and work it out. That's a much better scenario than taking the home and selling it on the market. But if that does happen, then we interact with MCAP in terms of selling that house into the market. So I should say that we've had losses over the years. The fund has been up for over 9 years. And we have losses, I think, in the range of, I should know, $750,000.
Oh, wow.
We have, over that time period,
Yeah.
so not a lot, considering the fund is currently $175 million.
Yeah.
We have a reserve against future losses as well. So to the extent the fund realizes losses in the future, the reserve that's been built up over time will absorb those losses.
So, just to the mechanics of the fund, you post the net asset value once a month, that the value of all the mortgages and things like that, and of course fully audited, once a year and all that good stuff.
Yeah.
When you look at the income stream that's coming in from these particular mortgages and things like that, and the fact that this net asset value has stayed the same, how do you think that the 6%, which is actually, just looking here, the 1 year number 6.29, and your 5 year number as of the end of June is 7.39% per year for the F class fund? How are you able to achieve that? I mean, those are some pretty solid numbers when you look at a 5 year GIC that's kind of been stuck between 2 and 4% for the last 10 years.
Yeah, thank you. I agree. We're happy with the track record. It's the insured component is a big benefit to us because it provides safety with solid returns, and that's a unique aspect of our relationship with MCAP. So I give a lot of credit for the safety of the returns and the fact they're relatively high to that portion. We believe the risk that we take on the uninsured loans that I talked about and the New York loans is more than compensated for the return that we're getting paid on those assets. Yes, there's risk inherent in both those types of mortgages, and we try and manage that risk as best we can upfront with the underwriting process and then afterwards. But there are some healthy returns paid in those markets for those types of mortgages, and investors have benefited from that over the last 5 years.
Right. Okay. I want to go back to one of the things you said at the very, very beginning, and you said when you and Daniel came together there in 2013, you said your values have aligned, or were aligned. How important, and this is kind of off topic to the fund, I'll give you that, but how important do you find in the financial industry are values? I mean, maybe you're in a unique situation that, you were legal counsel for that many years. You've seen a lot of stuff go on. How important, in your years of experience, is values and trust and things like that to managing money and to the relationships?
I think it's critical. I think trust, and you hit on that word, is the number one element that you have to provide to investors or be able to engender in them. If your investors can't trust you from both an expertise perspective, but an honesty perspective, then there's no business to be had. So in the financial services industry, if you don't have trust, you don't have anything.
Right.
And we've spent a lot of time and effort, Daniel before I joined, on compliance and making sure that we follow the rules and building systems that are robust and will provide good investment results and also safety for investors. Critical from our perspective.
Right. Okay. Well, that's great. I really appreciate the time today. I appreciate your insights and going through in a overview of the fund. And congratulations on really great performance through the volatility we've had, quite honestly, so for the last few years. With the interest rates the way they are and all the volatility, you've managed to do a very good job. And I know clients that we personally at Starratt Wealth Management have in the fund have been quite happy with the fact that it pays out, a pretty stable return on a monthly basis, and really kind of hits, which I'm sure your parents appreciate too, hits the the monthly income and really helps that, because as we know, a lot of people that are relying on their income today, or relying, on their investments for income, are finding it harder and harder to generate a reasonable income return. And sounds like that, as you pointed out, will be the norm for years to come.
Hope so. Yeah, well, thank you for the feedback. Appreciate this and the opportunity as well.
Yeah.
Thank you.
Okay, thanks. Have a great day.
Take care, Scott. You too. Bye-bye.